Okay, a couple of announcements before we head in today. In the AI section later in today's video, I'll be talking about different models. One of them I'll mention is Manus, which is absolutely impressive. It's a Chinese model, the free side, which is all I've been using. Absolutely impressive. On the free side, you're limited by the number of credits that you get. So I have a link in the description box. If you click on that to sign up for Manus, you will get an additional 500 credits. I will also get an additional 500 credits. So it's, it helps me. It helps you and it helps me. So if you're interested in trying out Manus, give that a shot. It is impressive. The free side is on par with some of the paid stuff I have from the US suppliers. In the AI for Finance stream, I've introduced critical thinking, critical reasoning videos in there as well. The first one went up Monday, and the continuation of that one will go up this Monday, which is tomorrow. And tomorrow we will dive deep into the structure of arguments. We're going to look at premises and conclusions and the structure of arguments in various forms of communication. We'll look at the implicit and explicit components of arguments, and we'll look at something called warrants. And once we're done with this, we'll look at three different arguments. One by a president of a U.S. central bank, one by a podcast host, and one by the CEO of MicroStrategy. And as you read them, once you have this skill, once you read, you can't help but see the structure of the argument as you're reading something. So weak arguments just jump out at you. You can spot them right away, and you can spot why they're weak. So we will use AI to help us with this. We will come to conclusions about Christopher Waller's speech, about Friedberg's statements, and about Michael Saylor's Oppenheimer presentation. And then we'll ask ChatGPT, their reasoning model, to evaluate the quality of the argument, but we have to prompt it. You wouldn't know what to prompt unless you understood how to evaluate the quality of an argument. This is why the existence of AI does not relieve you from knowing all the stuff that it can do on its own. You must know that first, because then if you don't, you'll never be able to tell it what parameters to do something with, because you won't know the parameters. So we'll prompt it to look at the arguments in terms of the soundness of the argument, the implicit and explicit components, and whatever warrants happen to be attached to the arguments. And we'll see what output we get from Waller. Here we'll find that he constructs very good arguments, bulletproof arguments. We'll look at the one from Friedberg, and we'll see that it is an unwarranted argument. Then we'll look at Michael Saylor and stand back. Everything that can be wrong with these arguments is wrong, including outright fabrications. We'll use Manus AI for that one. Manus AI, as I said, is really impressive. So we'll see what ChatGPT can do. This is the O3 model. You got to pay for this one. This one's free, and we'll see what it can do over here. Next week, we'll go into common logical fallacies for the AI for Finance series. Let's start with the jobs data that we got on Friday. Help us understand the forcefulness of the rally that we got. And I'll go through two screens. After I had laid out the two screens, I was sort of puzzled as to what was the rally all about. I mean, if we really do the analysis, there wasn't really a reason for that kind of rally to push to 6,000, but I'll let you be the judge here. To assess it, we're going to need some background information first on household and establishment. Let's look at the method. These are all samples. Sample size for the household is 55,000 households. That's down 5,000. It's a smaller sample size than normal, which is 60,000. The response rate's held stable at about 70%. So you end up with about 38,000 responses here. Standard error is plus or minus 300,000. For those that have forgotten some of your statistics, the larger your sample size, the smaller your standard error. So let's say that you have a classroom of 30 students and you sample 10 to figure out what the average score was on the last test. You're not going to get the exact average because you only sampled 10. If you sampled 20, you'd be closer to the exact average. So a standard error is your measure of precision. If you sampled the entire population, you would have no error in the estimate of your average because now you have a population average. So when you go from sample to population, you need some estimate of how precise are we. That is the standard error. This is saying 3 plus or minus 300,000. So if you say, well, we created 200,000 jobs based on the household survey, the standard error implies that, well, that means the true population average would be, the true population number would be somewhere between negative 100 and positive 500. If you increased your sample size, you would narrow that range, you would tighten the standard error. So it gives us some way of evaluating the number we get without having to worry which sample size was larger or smaller. We can just apply a standard error. The establishment standard error is tighter, 136,000, because it has a much larger sample size, 122,000 businesses. That represents some 600,000 locations. So if we think about a location as a household, it is significantly bigger than the household survey. But still, only 122,000 businesses are surveyed. Now that published standard error of 136,000 is based on a typical response rate, but response rates are really low. They've dropped to about 40%, which is very low. So because they've dropped to about 40%, even though you're sampling 122, you're really only getting about 48,000. If you're at 40%, you're only getting about 48,000, which is a little more than the 38,000. So this standard error really should be wider. How much wider, I don't know, but to say 150, 160 would not be unreasonable. When your sample size drops, your level of uncertainty increases. If you only took one student out of the class, out of the 30, and said, what did you get on the test? 62. That's the class average. I think you'd see that, whoa, that's that person's score. It's not the class average. The more people you count, the better your estimate is. So the fewer you count, the worse your estimate is. So we would say that the standard error should be wider than the published 136. But that's what we have. Okay, with that, let's start looking at the numbers. Household, let's start there. We're going to go in a U-shaped around here and see what we get. Labor force decreased by 625,000. That's a big number, and that's just the labor force. You had population growth from April to May, but the labor force decreased by 625,000. Participation rate dropped by 0.2. The employed dropped by 700,000. With a standard error of 300,000, we can confidently say at 90% confidence that the household survey says jobs were lost. Employment to population ratio down 0.3 to 59.7. You got to go back to 2020, early 2020, to get employment to population ratio that low. The unemployment rate unchanged. If the labor force is dropping, it would improve the unemployment rate, but if you're losing jobs at the same time, it would decrease. So they offset each other. Unemployment rate is unchanged. Full-time jobs, negative 623. Part-time, up 33. That is not good. None of this is good. The employed, that's not good either. Look at the age cohorts. 16 to 19, lost 142. Not good. 20 to 24, lost 163. That's not good. 25 to 54, negative 198. That's not good. 55 plus, negative 169. That's not good either. Less than high school, gained 209. High school, if you have at least high school, lost 233. If you have more than high school, less than the BA, lost 211. And BA, call it flat. In fact, here's March, April, May. 65 million 14,000, 65 million 5,000, 65 million 22,000. It's been going sideways. Last week we looked at unemployment rate of new graduates, and entry-level jobs are basically just drying up. This is sort of backing up that statement that jobs that have a BA plus holder to it are basically flat. Let's move over to the establishment survey, and let's start at the bottom over here with the diffusion index. I don't think anybody picked up on this. This is the percentage of industries with employment that are going up, plus 1/2 of those that are unchanged. So if you have a number that is less than 50%, it means you have shrinking jobs or job losses in that particular industry or sector. 50% means they're neither gaining nor losing. Over 50 means you're gaining. Look at total private, 250 industries. Last year was 52.6. March, 51.6. April, 51.8. May, 50. Neither expanding nor contracting. In other words, that is saying zero. Zero. Keep this in mind when we get to the jobs number and we think about the confidence interval. Zero. Manufacturing, 72 industries, 41.7. That is a wickedly low number. I thought we were bringing manufacturing jobs back to the U.S. 41.7. Last year was 46.5. Now we can recover services out of here because we have manufacturing in the total. So we just have to solve for X. 178 industries, 72. It's the 250 minus 72. 53.5. And if we do it across the board, last year was 55.06. Now we're 53.05. You can see from April to May was the big step down, 54.79 to 53.35. Services still adding jobs. Manufacturing is shrinking. When you combine the two together for the economy as a whole, you get 50, which is zero. Now let's, now that we've done this sort of route, let's go up to the top here. Let's start with revisions to March. 185 was reported. The market threw a party. Actually, that's 120. Got revised down to 120. What if it was reported at 120? You would have had a very different market reaction. Did the market say, hang on, we need to adjust? No, it did not. It just ignored it. April, 177. Sorry, that was 147. So it got revised downwards. And we printed 139 and threw one hell of a party. We decided household, we don't want to pay attention to that. Revisions, we don't want to pay attention to that. Diffusion index, we don't want to pay attention to that. The expectation was for 125. We beat by 14. Let's make this market more expensive. 14,000. But let's consider the standard error. And remember now, this is a published standard error from some time ago, is not accounting for the drop in the response rate. This standard error should be wider. Let's say we use 150. Let's go back to March, 120. That interval would contain zero. You cannot say with 90% confidence that March created any jobs. Go to April, 147. You cannot say with confidence you created any jobs. Go to May, 139. Again, you cannot say with 90% confidence that you've created any jobs. Even at the 136, even with the lower response rate, if we take the more optimistic standard error for March, you still would be concluding zero. And these slightly are above zero, the 139 versus 136, you're 3 to 275 on the interval. Doesn't include zero, but almost includes zero. But we're not going to pay attention to that. Private gained 140,000. Goods industries lost 5,000. Services gained 145. Again, look to healthcare. Retail. This is very odd to lose employment going into summer. Negative 6.5. Temps negative 20,000. Average weekly hours unchanged. Average weekly earnings up 0.416. That doesn't mean anybody that people are making more money. Under the hood, each month there's about 5 million to 6 million jobs that change hands. 5 to 6 million. Now I want you to think about entry level jobs almost disappearing. Well, you don't start at 500,000 a year. You start at 50, 60,000. You work your way up. So just because of the churn underneath, you could have a situation where nobody's making more money. It's just you're not counting lower paid jobs because they don't exist anymore. So it would be skewed towards the higher paid jobs. So it could just be a remnant or an artifact of just the structure of the job market, in that nobody's really walking home with more money. It's just that the average appears to be higher because entry-level jobs are just not appearing. Or it could be that people are making more money, right? These are just, we can't say with any real conclusion on this one which one it is, but we can hypothesize what it could be and have different possibilities for what could be explaining it. Taken all in all, it is difficult statistically to conclude that this economy is creating jobs. Okay, let's stick with the establishment and household surveys. Let's move to Fred to look at some historical data. Top panel establishment, bottom panel is household survey. We have to eliminate January, 2,234,000, because that is a statistical catch-up, which is an adjustment made this January, so we can't really include that. So February to March, household survey says 622,000 jobs were lost, whereas the establishment survey is saying February to March, 508,000 were gained. We cannot apply the standard error to the aggregate number, because this would say, yes, we can confidently say jobs were created. Yes, we can confidently say jobs were lost. You must apply it to each of the individual numbers. And the standard error here was 136,000. Really, it's more because the response rate has dropped, but we'll use the more aggressive number. The interval here would contain 0. Interval here would contain 0. Interval here would contain 0. Here we can say at 90% if we use the 136 that we have. But if we say, well, it really should be 150 or 160, you would be saying we cannot confidently say anything here or here. But we can, if we're using the 136, say it looks like it. If we go to the household survey, 300,000, we can confidently say jobs were lost in February and in May. We cannot say any jobs were created in March because the interval would contain 0, but we can say that jobs were created here. So when we combine the two, we are confident about April in both of them. Again, not adjusting for the standard error. However, we have zeros all along here and an almost 0 at 139, whereas we have confirmed, statistically confident, I shouldn't say confirmed, statistically confident evidence of job losses in February and in May. So if we are true to the data, these are not good reports overall. This is not a great start to the year. This is not an economy that statistically and confidently appears to be creating jobs. This is an economy that statistically, based on the evidence, appears to be stagnant, appears to be flat in terms of job creation. Let's look at challenger job cuts. Add that to the pile as well. And remember last week, the elevation in unemployment rates we saw for recent grads. Another piece of the puzzle. This is the third piece, challenger job cuts. We got this report in June. It was up to May. Whenever you get the June report, it's for the month of May. The May report's for the month of April. 98,816 cuts in May, up 47% year over year. But 1 month is nothing. Year to date, that's more important. January to May, 700,000 cuts, up 80% year over year. All of 2024 only at 765,000. We're at 700,000 at the end of May. And we have an intersection set in the economy of tariffs, economic uncertainty, and AI. I have a screen coming up showing companies that are cutting jobs and blaming AI, saying it is AI. We had David Sachs on the All In podcast last week defending this because he has no choice. Government's defending that AI will not take jobs. That is, I think, irresponsible. It is clear that AI is taking jobs, so we'll look at that. 765 for all of 2024, 700,000, and we're only at May. Let's look at year-to-date, some year-to-date numbers. This is just for the month of May here, services. This is year-to-date services. Very particular industries and services. It's not counting a whole bunch of the other, like retail, tech. We consider those in services, not goods. 44,273, up 79% year over year. Worst May since 2020. Retail, a little over 75,000 year-to-date, up 274%. That's a head-scratcher. up 274%. Tech, about 75,000, up 35% year over year. And cuts are coming from wide areas. They're not concentrated. So we can't say, well, it's one particular industry that's having difficulty. Let's say housing. We saw a lot of job losses in housing. We could say, well, that's understandable given the backdrop, but that doesn't mean the economy is weak. It means housing is weak. This is coming from wide areas. By the way, you can get this report if you Google Challenger Gray Christmas June job cuts report. You can get this one. Job creation. They also track job creation announcements at historic lows. And I thought all of those announcements that were done at the White House, 800 billion, 200 billion, 120 billion, new factory here, new this, new that. No job creation announcements. And I didn't think there would be. I don't think much is going to come of those announcements. The last time there were these big announcements, very little of it actually happened. But people can read this president. All you have to do is give him a public victory and he'll take his eyes off you. He'll ignore you and you can get some gifts from him. So just make a big announcement. You'll be his friend. You'll give him some public exposure that his stuff is working. How many trillions are coming to the U.S.? And none of this is actually happening now, mind you. I mean, these were just announced like a month, 2 months ago. What do you expect? But still, you'd expect to hear something along the lines that we're going to start, this summer, break ground. It's going to create 1,500 construction jobs. That would be an announcement of job creation that happened in the month of May or the month of April. None of those were at historic lows. Taking it all in perspective, job cuts that are elevated 80% year over year. Numbers reported every month from samples. These numbers are statistically generated, so you must apply the rules of statistics to it and say, what can we say confidently? Because it's not truth. When we say 111,000 jobs were created in January, that doesn't mean 111,000 were created. That means that's the best number we got. That's the middle of our distribution. Based on our sampling technique and our sample size, we can feel a certain amount of confidence that 111 is the right number. Well, what level of confidence? 90%? Not 90. 88? Probably not 88. 86? Probably not 86. Well, you don't seem too confident, do you? Add that all up. I don't really understand the party that we threw on Friday. Let's move on to rates and yields. Decisively kicked out of the party on Friday. Not only did a party break out in the equity market, but they called in the doorman and they escorted the bond market out, threw him out on his ass. TLT lost a lot, down $1.13 or something that day. Because of course, how can Powell cut rates when you created 139,000 jobs? If you, again, take the tour that I took, you would say, wait a minute here, this is not good. And if you look at the last 2 months of inflationary data from CPI and PCE, you would say, well, it appears job done. The Fed has permission to cut. Not only permission to cut, they should be cutting at this point in time. If they are trying to meet the economy where it's going to be in 6 months or 1 year, you would be cutting now. You would be cutting. But look at the probability here, 97.4 on nothing happening. That is a big mistake. They have permission to cut. Now, these are smart people. I don't know that they're going to look at the 139 as a statement of fact. I think they're smart enough to recognize that this is a statistical output, which means you must be true to the statistics that created it. And if you are, you would see that, hey, since January, these numbers are barely any different than zero. But job cut announcements, those are objective. You can see them listed, up 80% year over year. You've had the last 2 readings of initial jobless claims that are elevated. Last 2 months of inflation readings that are benign. And if you annualize the last 2 months on all measures, you get below the Fed target. They should be cutting. Now, I don't know if they should be cutting 100 basis points like Trump suggests, but at least the 25. I can see a 50. I can make a case for 50. If they're going to be forward-looking, if they're going to meet the economy where it's going to be in 6 months or 8 months, they would be cutting 50. But I think they're going to go with no cut. I think that is going to be, it'll be looked back at as a big mistake. And if they go with none, in a meeting or two, they'll be doing catch-up cuts. So they really should be cutting. Long end of the curve from the 2-year out to the 30-year up. 30-year pushing back towards 5%, 4.97. 511 was the last cycle high. I don't know. I got a feeling that we're going to be printing new highs on the 20 and the 30. I don't know about the 10. We're a long way from there. 451. 4.5 seems to be the sentiment number, that above 4.5, negative sentiment seems to increase. Below 4.5, you get positive sentiment coming back in. Cleveland Fed CPI now for May, because we get CPI coming up in 3 days. We get PPI in 4 days. Core 0.23, headline 0.13. Annualize the headline on CPI, and you're below 2%. This is just month over month. Year over year, core 2.84, headline 2.4. The target is 2. The long-term target is 2. It doesn't mean that it's 2% every single month. The long-term target is 2. Usually you have a range of 1 to 3. That below 1 you start to get worried, and above 3 you get worried. With 2 being your target, you're 2.4 based on CPI now. We'll see what happens on Wednesday morning. And then Thursday morning is just the other side of the coin. WASD report in 4 days as well. So this is important for food inflation because it'll affect crop prices. And Thursday, let's keep our eye out. We have a 30-year bond auction. How that is going to go will depend on how we get there. Does the bond market get thrown out more and more? Does this cross 5%, 5.05, 5.06, 5.07? If it does, that sentiment, I think, will cause this bond market or cause this auction to not go as well as the market would like. And that might be affected by the CPI and the PPI before we get the bond auction. University of Michigan consumer sentiment in 5 days. This is for June. This is preliminary. That might show a boost in consumer confidence, all because of, mostly the trade policy directed towards China. Fed funds rate, Q2, basically nothing's going to happen because this is the end of Q2, is this next meeting. So you can call this a zero, basically. Q3, not even one cut in Q3, 17.5. Call it half a cut, and 1 cut in Q4 for 45 basis points. Q1 pricing in 19, you got 64, which is about 2.5 cuts in 8 meetings. I am still long. I closed my Octobers at 90. I think I got 95, 93, because that was pricing in 1 rate cut. And I thought, okay, well let's close those and move forward. So I'm long the January. I added to that. I really added to the May contracts, and this doesn't have a lot of liquidity. So you put a bid in and you wait for it. You get it, you don't get it, but you got good liquidity in May. So I'm long Fed funds here. I think a little over 30 contracts now across all 3, because I think this is wrong. And if we do get a rate cut, if they do look at the job cuts report, if they do look under the hood of the jobs report and dig a little deeper, if they do include some anticipation into the future of the potential damage that AI can cause before it starts to create jobs. It's not ready, I think, to create a lot of jobs, but it is ready to destroy a lot of jobs. If they do that, they may conclude that they can cut 25. If they do, I think I'm going to do very well here. I think this curve will start to do this very rapidly, and long end of our curve will start to come down a little bit more. The short end will come down, and hopefully the long end will come down, and I'll win in a whole bunch of different places on 25 basis point cut. I don't think I'm asking for much. Reverse repo, we could see that that is dropped down from over 300 billion, 149 now. Reserves 3.36 trillion. I don't even know that these are worth watching anymore. The runoff of the balance sheet is so very, very slow that it's not even happening. TGA 376. This is worth watching. You got to have that bill pass the Senate by July 4th, right? And the TGA is running out of money. That raises the debt ceiling by $5 trillion. And that bill caused a very public breakup last week between Donald Trump and Elon Musk. A fight that you have to give the weight of the victory to Trump right up front, because he can hurt Musk in so many ways, but Musk can only fund other candidates and take power away from him, but at what cost? At what cost? And what we've seen is Musk delete some of his tweets that he put up there. He deleted the one about impeaching the president. He deleted another one about the Epstein, I think the Epstein stuff. He deleted that stuff. So he deleted quite a bit. I think he backtracked saying, yeah, I'm richer than he is on paper, but I don't have the office. I don't have the Justice Department. I don't have the SEC. I don't have NHTSA. I don't have all of those things. If Trump wanted to, Trump could shut down almost everything that Tesla is doing and SpaceX is doing. Obviously, he has his own social media platform. X is a competitor. He could do a lot to shut that down or to make it very difficult. So there's a lot of damage that he can do, and Trump doesn't forget. Disloyalty, he does not forget. Musk's name is on that list in his coat pocket of everyone he's got to get even with. That's the last place you want your name to appear. When you walk into a room with Donald Trump, you don't get to leave the way you came in. I mean, we can just look at history. You could just look at history of the people who were in his circle and how they left. There are only three exits that I've seen. Musk decided to take two of those exits. But you don't get to walk out the door that you came in. That door gets sealed forever, and there are three exits. One is to jail. Peter Navarro, Paul Manafort, Michael Cohen. Another one is in disgrace. Rudy Giuliani is the poster child of that. Rex Tillerson getting publicly fired. How many people did he just publicly fire? You leave in disgrace. The other is a very public fight with name calling. Now, we haven't had a name yet. There was some rumor out there that his name was Mediocre Musk, a tweet that Trump had put out, or it looked like Trump had put out, calling him Mediocre Musk and that he should think about going back to Africa. That was fake, turned out to be fake. Even news organizations were quick to admit that this is fake. So that was quickly ignored. He doesn't have a name yet. I think it's rather suspicious that you had the leak of his drug use just before this happened. So now you have this fallback of like, well, he's on a lot of drugs. He really goes crazy when he's on drugs. The word crazy was put out there a couple of times. I don't know if that was leaked on purpose to set the stage for what they expected would happen. And now they have something, to point to, saying, well, he does a lot of drugs, right? I mean, you can't listen to what this guy is saying. I don't think that's over. I think it would be wise for Mr. Musk to be very, very quiet, maybe even send an apology through proper channels. It doesn't have to be a public one, but at least an apology to minimize the damage that will be done, because damage will be done. He must pay for that kind of disrespect in Trump's mind, for that kind of disloyalty. A price must be exacted. It must be exacted. Week over week, TLT down 1%, I think mistakenly. SPY up 1.5%, I think mistakenly. And the dollar index down 0.15. I have no opinion on this. I think the direction over the next 12 to 24 months on the DXY is downwards. On Friday, after the market closed, I had put in a bid for another 2,000 shares of TLT. 85.32, I think I got them. And I didn't do much in terms of beta for the week. On to real rates, all of them up significantly. 2.68 on the 30-year, higher than the beginning of the year at 2.48. And May 21st, 2.75 was the high on the 30-year real rate. 252 on the 20-year, 258 was the high, higher than the beginning of the year. All also are lower than the beginning of the year and nowhere near their October 2023 lows, but still elevated. The 10-year real rate, 2.2. Inflation expectations that are built into the nominal versus tips market all have ebbed a little bit. These are break-even rates. And OAS, really not a lot to see here, except Triple C is starting to say, do we have to go along for the ride here? 6.85 on the 30-year. Still 1 week change down, 4 basis points, which is not bad, being that the 10-year was up week over week. Mortgage rates still were capable of dropping 4 basis points. And issuance, we look at debt issuance, and it looked like for the first part of this year, last month we were running below last year. Not anymore. Issuance year to date is up 1.2%. Investment grade last year for May was 133 billion. This year, 165 billion. High yield down a bit, 33 billion last year, only 30 billion this year. And convertible, 17, almost 18 billion last year, down to 14. Investment grade pulling up the weight, and with the performance for May this year puts the year up 1.2%. Debt, more debt. Okay, let's look at our Truth Social corner. The first two over here has to do with Mr. Too Late at the Fed. Too late at the Fed is a disaster. Europe has had 10 rate cuts. No, it hasn't. We have had none. Despite him, our country is doing great. Why would you say that? You're not cutting, but listen, we're doing great. Go for a full point. That is 100 basis points. Go for a full point. I don't see that happening. Rocket fuel. And then another follow-up here. If Too Late at the Fed would cut, all caps would cut, we would greatly reduce interest rates, long and short, on debt that is coming due. Well, I don't know how the long would take it. That would have to be on the Fed in the press conference to ease any concern. Would have to say things like, we really see that inflation has been tamed, and our biggest concern now is deflation. We see that coming. Now, if he said that would do a lot. Long and short on debt that's coming due. Biden went mostly short term. Well, let's blame the right person. Yellen went mostly short term. Biden had nothing to do with the Treasury. I don't even think he would have had any idea what to do with the Treasury. There's virtually no inflation anymore. Well, good thing you use the word virtually. I think that's a better word than literally. There's virtually no inflation anymore, but if it should come back, raise rate. So, to counter, very simple. See how simple that is? He knows more than central bankers. He is costing our country a fortune. Borrowing costs should be much lower. Now, I agree with him on the direction of rates. I think the Fed, and I've said this for some time, and we've done a tour of the employment data now and the job cuts. We've seen the inflation reading, and we know what's coming on the horizon. They can cut 25 basis points. The long end of the curve going up has made monetary policy more restrictive. Even though the Fed hasn't raised interest rates, all credit is priced on the long end of the curve. It has now become more restrictive. They've got permission. 25 to me would seem like a no-brainer. 50 would be courage, and I think that would probably be the right thing. I wouldn't balk at 50. I'd look at 50 and say, well, given these jobs numbers, yeah, it seems to make sense. But 25 to me seems like a no-brainer, so I'm with the guy on this one. but for different reasons. I actually have done the work and the detail and using the numbers. He's just saying, look, we want lower debt costs. And I agree with that too. So on this one, I think we're on the same page. Top corner up here, we have this next week. I am pleased to announce that the Secretary of the Treasury, Scott Bessent, Secretary of Commerce, Howard Lutnick, and United States Trade Representative, Ambassador Jameson Greer, will be meeting in London on Monday, June 9th, with representatives of China with reference to the trade deal. The meeting should go very well. Thank you for your attention to this matter. Thank you for your attention to this matter. So there's they did agree to keep talking. Of course, they're going to keep talking. You got to get somewhere. But I don't see China bending. I don't see China saying, "Yeah, okay, let's get all this done." I think China's going to have some very specific demands that it wants met, and one of those is going to include some very public levels of respect. So I don't know what's going to come out of this, but this administration is going to do a good job at trying to monetize as much as possible in the economy, every headline that it can. So you do have this on Monday, which when it was announced on Friday, when it did come out, this was 2:30 on Friday, when it did come out, there was a noticeable increase in SPY pricing. So the market did take that into consideration while it was throwing a party, kicking out the bond market. It certainly welcomed in the China market at the same time. So the result of that will happen Monday. And in case you were wondering when it would happen, it has happened. It's time to put President Trump on Mount Rushmore with the other expansionist presidents, because he did, with courage, rename a body of water. That's got to be enough. He called it the Gulf of America. Well, there is South America and there is North America. So he renamed the Gulf of Mexico after two continents, South America and North America, which makes sense because it does border South America and it does border North America. So maybe Gulf of America makes sense because it borders the Americas. You should have called it the Gulf of United States, because the country is called the United States. America is the continent it's on. But let's not worry about that. Let's stick the guy on Mount Rushmore. In case you were wondering when it was going to happen, Congresswoman Anna Paulina Luna sponsored the legislation to put our 45th and 47th president on this national memorial. Sign the petition to support our effort. You can sign the petition to get President Trump on the mountain. NBC interview. This, I think, is going to be important for Tesla. By the way, I did sell calls, 30250s. 1 week, I sold the June 13th 30250s. I got about, I think, $12 and change for 1204, something like that. I didn't go crazy on these, but I did sell two of the calls. NBC interview. The thing is, once you end up on Trump's list, you're on his list. There is no, based on, and I'm just basing this on history. There is no recovery from that list. You are on that list. You must pay a price. You will pay a price. And every chance he has to hurt you, he will take it. That's the character. And you have to know the character of the person. Musk will face very serious consequences if he funds Democrats. I think that's why they tried to engineer a nice exit from the White House by giving him the key, in hopes that, look, yeah, let's get this guy out of here, but at the same time, let's not lose his money. Maybe we don't need his money, but we certainly don't want his money going to the other side. Very serious consequences if he funds Democrats. Well, look, he's already going to face very serious consequences. They're not going to take the chance to see if he funds the Democrats. They're going to take him down before that. Also said he has no desire to repair his relationship with Musk. That is on character. I have no intention of speaking with him. That is on character. I think it's a very bad thing because he's very disrespectful. That in itself is going to be a punishment. So, that is going to be something to watch. I don't know why anybody would expect it to rally from this point. Dan Ives did come out on Friday, as I expected. I did a live, I think on Wednesday or Thursday. I said all that's left is for Dan Ives to come out with a $1,000 price target. But he did come out and say, oh, I think this will blow over in a couple of days. I don't think it will. This guy has on that list inside his pocket that kid in kindergarten who took his building blocks. He just can't find them. But when he does, when he finds that kid who took his building blocks when he was 5, look out. Look out. So I don't think this is done. Let's have a look at gold and copper. They've been performing quite well. Gold more consistently than copper. There are 2-year charts for both of them. You can really see how gold is just accelerated. A high of 34.58 back here. We're sitting at 33.31. I think it's just inevitable that we take this out. I think 4,000, 5,000, 6,000 is inevitable, as well as we move into 2026, 2027, 2028, 2035. If you said 15,000 an ounce, I wouldn't say that that is unrealistic. Gold year to date up 23%. Newmont year to date up 42%. The largest gold miner with a lot of copper. Down here we have the largest copper miner with a lot of gold. So those are 2 nice ones to have. Up 42%, a 1 month, down 0.82, but gold is down 0.67 over the 1 month. Newmont had been trailing for a while, just hadn't been going along with the rise in gold prices. It is now, but it still is a company with an income statement. Same with Freeport, company with an income statement. I'd rather just bet on price. So if I were betting on gold, I would just bet on gold itself, the futures contract. If I'm betting on copper, I'd just bet on copper itself. I've made that statement before that I'd rather just bet on the commodity itself. Let's look at Freeport, up 10%, almost 10% for the year, 11% in the last month. Copper is up 17% year to date, up almost 5% in the last month. For gold, the last 3-year performance up almost 80%. Newmont up 80% over the last 3 years. If we can contrast both copper and gold with Bitcoin, because that seems to be the argument that crowd wants to make. Bitcoin year to date is up 10.26%. You would have done better in gold, more than double in gold, and you would have done better in copper, some 70% more in copper. 1 month up 8.43%, 3 years up 60%. And you would have done better in Newmont, up 80%. Gold was up significantly over those 3 years. So over this period of time, whether it be 1 year or 3 years, not counting volatility, just counting the performance of the underlying target. I'm not going to call them assets, the underlying target. Gold was the clear winner. If your expectation is continued U.S. weakness, that is a lift for both copper and the U.S., but I don't know that you'd want to make a commodity bet based purely on your forecast for the U.S. dollar. The energy build-out and a lot in global infrastructure and AI finding its way into physical form. All of this takes energy to get things done, which means copper, because anytime you move energy from one source to another, it has to move along something. Copper is the one to use. If I had to put all my money into one thing and one thing only for 5 years and not touch it for 5 years, hands down it would be copper. Here's its 2-year chart. 532 peaked and then came right back down. I mentioned at the time when it was doing this, China had shut down some smelter capacity, that we have no copper shortage here. This was May 24. I said, give it a year or two and we will. Here are the tariff scares that everything pulled back on, but it was making its run up, 529, and it did get to about 510 by the end of last week. And by the end of last week, the price gains were, you look at copper every day, up 13 cents, up 18 cents, some big moves, selling off during the day, but still. And most technical analysts will tell you we have a big solid double top. There are no triple tops. So I think it is inevitable that copper takes out 530. So I think $7 to $8 to $9 copper by the time you get closer and closer to 2030 is not unrealistic. We're sitting at 480.83 right now. I haven't gotten aggressive on this, but at some point I am going to get very aggressive on any pullback below 455 or 450. I probably will get very aggressive on copper. It is, in my opinion, the single best bet going forward. And what will give it more headwind is I do expect that over the next 12 to 24 months, the U.S. dollar's direction is to the downside. That will only boost the U.S. dollar price of copper globally. Okay, SPY. Forward 4-quarter operating earnings sitting still at the 269 mark, 269.65, closing SPX 6,000. Just to print that 6,000 number, that puts us at 22.25 times forward earnings, with 10% across the board tariffs, with 50% tariffs on aluminum, steel, with 25% on cars. Add them all up, put all of that there with the same person holding the White Office, the person who is volatility embodied. We are pushing right back up on the valuation. And of course, what do you need volatility for? 13th week percentile for implied volatility, 0%. That means it's the options market is pricing in the lowest level of expected volatility in the last quarter as of the close of Friday. Nothing to see here. Everything is going fine. No reason for any volatility. I think that is wrong. I mean, go ahead and push up on your price, but at least suggest that, look, the ride up here is going to be bumpy. We are pushing up to 22, 23 times forward earnings in a questionable and uncertain economy with leadership that is volatility itself. At least do the market the honor of at least saying, hey, listen, in the options, you're going to have a lot of implied volatility, but to suggest that, no, you're not even going to get paid for that now. I think that is completely wrong on this one. But dropping across both the 26th and the 26 and 52 week, 6/12/30, February 19th, all-time high. I didn't think it's possible, but look at this. We're sitting 2% below that number. These types of recoveries, every time you have this, even within this pattern, you have these V's. It's a head scratcher. It seems that the market wants to go up for no other reason than to go up. That it does not appear to be fundamentally supported. IWM down only 12.5%, ended at 211.90. IJR at 107.67, down 15%. I'm long on these. I'm short on this. I have net positive beta. Triple Qs only 2% down, 529. 2% down from an all-time high. 2% down from an all-time high. I don't know. Are we going to get an all-time high? LSEG and Sector Spider both agree on 3 companies reporting next week. That must be the threshold. If it's below 5, they can handle it, right? Well, by the way, I forgot to mention on the previous screen, all of the numbers that I got in performance year to date, the 1-month performance, the 3-year performance. If you go to Google Finance, Yahoo Finance, if you go to Koifin, you will get different numbers from all of them. If you say, what's the year-to-date performance, they'll all give you different numbers. You actually have to go into Interactive Brokers, look at the chart, look at the closing price, the actual closing price of the market, and calculate it. And that is different than all the public sources as well. I don't know why so many places are so wrong when it can easily be verified. This stuff is easy to find. I'm puzzled. All these places, all these companies that sell these data subscriptions, and you wonder, am I even getting the right data from you? If you can't even get this stuff right. So as I was doing all those price checks, the percentage, depending on what site I used, I got a different number. I said, this can't be right. I mean, it can't be right. And well, anyways, we have a Staples on Tuesday, Smuckers, and then you have Oracle and Adobe on Wednesday and Thursday. So we have a market that, if you look at the data from last week, even the PMIs were not good, suggested that you had an economy going in the wrong direction. Look under the hood for the employment and the jobs numbers and put it in perspective, in statistical perspective. It's not good. Look at the job cut numbers. It's not good. But the market just doesn't seem to care. It seems to keep shrugging off everything, saying, we're looking past this. Well, how much can you look past? We're looking to 2026. Yeah, but nobody knows the future. So you're looking towards a future that you're just entirely making up, as opposed to looking at the facts on the ground. Now, when we get to the AI stuff, the best advice I heard from this so far, because I think it is true, because I've been looking at it saying, well, where will I be in a year? Where will I be in 2 years? And it's hard to make plans for 2 years from now, saying, okay, well, I'll focus on doing this kind of work. Yeah, but what if in 2 years you're right back at this saying, okay, well, I'm being squeezed out of this by AI. Where will I go? He said it, I think, the best way, and it was just refreshing to hear somebody actually say it. You cannot have a 5-year plan. You can only have a today plan. So when it comes to the market and pricing out the markets, I think he's right. You cannot look through all of this and imagine what next year is going to look like. You can only have a today plan. And my today plan says this doesn't make any sense. To have implied volatility at the lowest it's been in the last quarter, while real volatility out there has never been higher. This administration is nothing but volatility, and the data do not support an economy that's growing. It supports an economy that is stagnant, if not shrinking. Okay, this continues with the theme I've been talking about for some time about AI. We did have in the All In podcast, David Sachs come out and aggressively defend the job creation ability of AI. It is not going to take jobs, it's going to create jobs, almost laughably dismissing anybody who thought otherwise. So I thought, well, let's go out and find out. Let's see if we can find some headlines from some companies who are eliminating jobs and particularly blaming AI. And you know what makes it easy to find this stuff? AI. So I did. Klarna said in May that 40% cut in headcount is due not only to AI, but also to attrition after the company instituted a hiring freeze. We're going to see Shopify did the same thing down here, a hiring freeze. The Swedish provider of buy now, pay later loans, I've heard it referred to as buy now, default later, but buy now, pay later loans has been outspoken about its aggressive adoption of AI tools across the company, particularly in the customer service unit. The company said last year AI was doing the work of 700 customer service agents. Likewise, Shopify CEO told employees in April they will have to prove why tasks cannot be formed by AI before asking for more workers and resources. So AI is replacing people. AI is being leaned on for resources. And we need to hire 5 people. Why can't AI do it? Well, those are 5 jobs that would have been created that are not created. Maybe they're not outright lost, but they're not being hired. I'm in the same position. Earlier in the year, I was saying, look, I could hire 5 people easily. I mean, I need to massively increase the amount of output that I do. Now, no, I don't need to hire anyone. I can increase that output and better output than I thought I could get without people. So jobs are being lost by not even showing up to begin with. Let's keep going. CrowdStrike, May 7th, announced plans to cut 500 employees. Now, 500 doesn't seem much. You got to look at the percent. This is 5%. This is 40%. 500 employees, or about 5% of his staff. CEO in a securities filing attributed the move largely to artificial intelligence. We're operating in a market and technology inflection points with AI reshaping every industry, accelerating threats and evolving customer needs, adding that the move was part of the company's evolving operating model. Chegg AI is really going after three big categories. Number one is coding. We're going to see that down here with Google, and we're going to see it Autodesk, Meta, Microsoft. Going after code. It's going after tutoring service, education services. Chegg is basically going to disappear. And a whole bunch of other companies that are in the SAT space, SAT tutoring, that are in the GMAT space, the LSAT, the MCATs, all these standardized, these are called aptitude tests. They'll disappear. For 248, again, the number's not important, it's the percent, 22% of its workforce. The cuts come as AI-powered tools such as OpenAI's ChatGPT take over education. So here it's not as if they're cutting their workforce because AI eliminates their workforce. AI is their competitor, eliminating the need for this kind of service. And I agree. At this point in time, this company has no reason for existence. In about 12 months, the size of the test prep industry in aptitude testing will be half of what it is now and a shadow of itself in 24 months. It will just simply be gone. Autodesk, February 25, announced layoffs, 1,350 people. AI can do those jobs. IBM, 8,000. A lot in HR. Why? AI can do them. Meta, all of Llama's code will be AI generated in about 18 months. I got 18% in there. I don't know why. Let's just cross out the percent. In about 18 months, all of Llama's code will be AI generated in 18 months. Microsoft, 30% of code is already AI generated. They are going after code, they are going after education, and they are going after front line employees, entry level jobs. There's where you're seeing it now. This is a general technology, not industry specific, which means it cuts across all industries. So what I did is in consumer staples, I thought that's got to be the safest sector of the economy, consumer staples, because they make stuff you need. How are you going to have AI replace whatever jobs exists in making toothpaste, in making toilet paper, in producing food, in retailing food? I think about a retailer and I think, okay, well, what could AI do? Robots are not ready to replace anything yet. You already have self-checkout counters, so you're getting your customer to replace your employees. But you got to stock the shelves. These are physical products. You can't just eliminate anything. It's probably got to be the safest place. So I took a sample of 9 companies, put it in Notebook LM, and started asking questions about AI. And here's what we found. All of them mention AI, all of them. And this is where they're focused on using AI for operational efficiency. So all of these companies do have head offices. They do have IT departments. Well, you can eliminate some jobs in the IT department, some jobs in the finance department, some jobs in the HR department, mostly white collar. But they're the least susceptible to having 20% of the workforce eliminated. All right, operational efficiencies, enhanced customer experience, and improved internal processes. While these may not lead to job losses, they certainly would lead to no job gain. So I think here you could probably, AI seen as a great resource to add, such that you don't have to add headcount to get the same amount of work done. But so far, this sector is not announcing any job losses. I think it would be interesting to take 8 or 9 companies in the communication sector, 8 or 9 companies in information technology sector, and do the same thing. And take their 10K, their most recent annual report, and say, tell me every place in here where they talk about reducing headcount because of AI, or potentially reducing headcount because of AI, or anything they say about the implications of AI on their business operations. I think that would be interesting. I didn't do that. Why did I take consumer staples? Because I already had those 9 companies loaded up, and I thought, well, let's give this a shot. Google made several rounds of layoffs, including about 200 jobs in May. Again, that's really nothing in its global business unit as it shifts resources to AI product development and cloud services. Reports suggest that Google is contemplating further significant reductions, potentially up to 30,000 jobs. as it explores ways to automate ad sales. Automate means get rid of humans, and customer support with AI. That is AI taking jobs. Company CEOs acknowledge that these reorganizations are a direct response to AI's growing capabilities and the need to remain competitive. A little bit of background about my work in my PhD. What I did is I looked at significant innovations and where I wanted to know where in the business cycle do these significant innovations occur. The thinking was, well, it occurs in contractions because companies then redirect resources to newer products that then can compete or create new markets. Turns out it's at the top, at the peak, when employment is very low, when inflation is very high, costs are very high, companies get really creative about trying to avoid that. That's where innovation really occurs. So I took the top 1% of all US patents in terms of citations, because a significant innovation has a lot of citations. And then I mapped them to the business cycle. That's not really all you do when you do a dissertation. It is a full study of everything that you're doing. So you have to do a deep dive into the history of technology and the evolution of technology, because if you're saying that a highly cited patent is a significant patent that then has a whole bunch of follow-on technology to it, you have to understand the evolution of technology and how it unfolds. At the time that I did this, the fastest technology changes in technology, the fastest evolution in technology that I had seen was in flat panel TVs. The speed at which you went from $14,000 plasma TVs to $600 LCD TVs hadn't been matched in history. I don't know if anyone knows that little bit of trivia, but that was the fastest pace of technological change that I had seen until now, with the evolution of these and I'm just talking about the large language models. I'm not even looking at all of the field of AI. I'm not even looking at robotics or any of that kind of stuff, just the large language models. I have never seen an evolution of technology at this speed before. And I am somewhat of an expert on it because I've done my homework on this one. This is fast. It is not. Now, when I looked at LCD TVs, sorry, not LCD, but the evolution of flat panel TVs, that's a very specific industry. And that was really dominated by Asian companies. But that was a specific industry. It wasn't general purpose across all industries. It was very specific to that particular industry. And it was massively deflationary in terms of the price of flat panel TV sets, down from $14,000 period of 5-6 years, you're down to $600 at a superior technology. This is general purpose. It cuts across all industries. Now, one commonality of the evolution of technology that jumps out at you when you start studying this, one very common theme is whatever it is applied to is deflationary. If it's industry specific, it drives the price of that thing down. If it's general purpose, it drives the price of something else down. Whatever it happens to be. So electricity drove down the price of heating and lighting from what you had used before. It is deflationary. Yes, more of it happens, but it happens at lower prices. More of it happens because the price is lower. So there's no reason to believe that this is not going to be deflationary. But this technology is different than all the others that I've looked at. All the others that I've looked at, all the technology, if you took the technology and put it somewhere, it did nothing until a human came along and worked with it. So it really was about the human capital ratio. The capital to labor ratio. If you have 10 people working in a field, they can only do so much. If you put a tractor there and no human touches that tractor does nothing. But if the humans use the tractor, they can increase productivity. This is different. I can put this technology somewhere and it can do things without the human doing it. I don't need the human to do it any longer. Whenever you have technology in which you no longer need the human, you do lose jobs. So if we look at manufacturing in the US, we like to blame China because we could look at a chart and say, look at job loss really accelerated after 2000. And that's when China was allowed into the, or entered into the WTO, and manufacturing jobs went to China. Why did they go to China? Because labor was cheaper than automation in China, but not in the US. Had there been no China, there would have been job losses. There just would have been a lot faster pace of automation. So, because once you put a welding robot in place, you no longer need the human to interact with the welding robot. It's not as if it makes the human a better welder. It eliminates the human, and it is the welder. This is what this AI is, except now it's doing it in the cognitive realm, not in repetitive physical tasks, but in non-routine cognitive tasks. That once you have this, it is not that a human using it is going to be more productive. It's that it can replace a human. And the humans who do use it, where it cannot replace the human, will be more productive. I'm far more productive. And it cannot do what I can do. There are certain cognitive domains of which it is incapable of performing at, for now. There is some estimation that in the next 5 years, it will reach the higher cognitive domains. I don't know. I'm still a little skeptical, but I've always been skeptical of things. I kind of like to see the evidence of it. But I'm skeptical only because I know that there's a certain intuition you need. There is a limitation among humans that given 20 humans doing a particular task, 2 or 3 of them will clearly see more than the others. Their minds will see connections the others cannot see. I think there is some limitation there, and because of that, I think there'll be some limitation in the code on that. That I don't know that an algorithm will be able to do much more than what we would expect in terms of what the distribution is in the population. So I think that there's still some safety there. So when I talk about the trend in the technology here, I'm not talking about it from an uninformed position. I'm looking at it in terms of the history of all of this stuff. This is deflationary, and it's not just industry specific. It is economy generalized. To say there'll be no job losses, to say that this is not deflationary, is to ignore all the history of technological evolution, is to just ignore it all, put your head in the sand and say, no, 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 no. Now, I think a government-employed AI czar pretty much has to say that. But it is not true. It is going to happen. I don't know at what pace it's going to happen, but it is ready today to eliminate most entry-level jobs. Because most entry-level jobs really operate at the lower cognitive domains. So overall, I think we're ignoring a lot that has precedent. We seem to be ignoring the evolution of technological change. Now, if you're a government-appointed AI czar, you kind of have to come out and say, oh no, don't worry, there'll be no jobs lost, nothing to see here, folks, please keep moving. But we all have eyes. We can all see it. We've all used the AI tools before. We can see what it can do. We can just start imagining how much of our job it can do. If you haven't tried to get AI to do most of your job, give it a try. It's sobering. And I think the Fed is ignoring all of this as well. I see no reason why markets, given the economic backdrop that we have, and I think what's coming, I see no reason why they should be trading at 22 0.25 forward earnings, and it looks like they really want to go to 23 times forward earnings. I see no reason for that. I see no reason for the sell-off in the bond market. In fact, Friday, if you had treated Friday honestly, as precise as the data would allow it to be treated, you would realize that there's nothing to be excited about here at all. That for equities straight up, bonds straight down, I think that's a mistake. And I'm betting that way. I'm betting that it will be a mistake.